Hello, listeners. Welcome to the Morning Market Update, powered by AI. I'm Joe.
And I'm Sarah. Today is March 4th, 2026. Let's dive in. Starting with the U.S. markets, we saw a bit of a mixed bag in the overnight futures. The S&P 500 is trying to hold steady at the 4,580 level after a turbulent week. Yesterday's rally, driven by better-than-expected jobs and services data, managed to offset some of the ongoing concerns about the Middle East conflict. The Dow Jones is hovering around 34,200, showing resilience despite geopolitical tensions. Meanwhile, the tech-heavy Nasdaq is slightly off its highs, sitting at 14,680 as investors remain cautious about interest rates amid inflation fears. The Russell 2000, which represents small-cap stocks, is also showing some volatility, currently at 1,950. Sector rotation continues to be a theme, with investors shifting from high-growth tech stocks to more defensive plays like utilities and consumer staples. This rotation suggests a cautious sentiment among investors, reflecting concerns about potential rate hikes and inflationary pressures. As we go into today's session, keep an eye on how sectors react, especially with oil prices impacting inflation and the broader economic outlook.
Turning our attention to the Canadian markets, the TSX has been relatively stable, closing at 20,350 yesterday. The energy sector, as usual, plays a significant role here, buoyed by the recent surge in oil prices, with WTI crude hovering around $85 per barrel and Brent just above $88. This price action has provided a lift to Canadian oil companies, even though the broader market sentiment remains cautious. In corporate news, we saw some movement in the financial sector with the Bank of Nova Scotia announcing a new strategic initiative to expand its digital banking offerings, which could bolster its position in the competitive financial landscape. Meanwhile, the Canadian dollar is trading around 1.27 against the US dollar, showing some strength due to higher oil prices. This appreciation could have mixed impacts, benefiting importers while potentially challenging exporters. Overall, the TSX continues to reflect the global economic pressures, with investors watching commodity prices closely.
Let's take a look at the international markets. Over in Europe, the FTSE 100 is benefiting from its defensive tilt, trading around 7,500. The index's composition is coming into its own during these times of uncertainty. The DAX in Germany, however, is facing headwinds, currently at 15,200, as industrial data shows signs of slowing amidst global supply chain challenges. France's CAC 40 is trading at 6,800, with similar concerns about economic growth impacting sentiment. Moving over to Asia, the Nikkei in Japan is down to 28,500, reacting to inflation concerns exacerbated by rising oil prices. The Hang Seng in Hong Kong has also taken a hit, down at 22,300, as technology stocks face sell-offs. The Nifty 50 in India remains under pressure, trading at 17,200, as investors brace for potential policy tightening in response to inflationary pressures. For North American investors, these global movements suggest a cautious start to the day, with the Asian market's volatility particularly noteworthy. It highlights the interconnectedness of global markets and the ongoing impact of geopolitical events on investment strategies.
Now, turning to commodities and crypto, oil prices have been the center of attention, with WTI crude stabilizing around $85 per barrel after President Trump's assurances about ensuring tankers amid the Iran conflict. This has brought some calm to the markets, although the geopolitical situation remains tense. Gold is trading near $1,940 per ounce, serving as a safe haven amid uncertainty, while silver is at $23.50, reflecting similar trends. In the crypto space, Bitcoin has surged past $73,000, marking a significant recovery as institutional interest picks up. Ethereum is following suit, trading at $4,300. Notably, the recent rally appears to be driven by a combination of institutional accumulation and a risk-off sentiment in traditional markets, which often benefits digital assets. Investors should keep an eye on these trends as they reflect broader market sentiment and could signal shifts in risk appetite.
In North American corporate news, Broadcom has been in the spotlight after reporting earnings that exceeded expectations, with AI revenue doubling. This has bolstered confidence in tech stocks despite broader market volatility. However, Okta's report painted a more mixed picture. While they beat fourth-quarter estimates, their guidance was weaker than anticipated, causing some concern about future growth amid AI's increasing role in cybersecurity. In a different sector, ExxonMobil is expanding its green energy portfolio, announcing a significant investment in carbon capture technologies. This move aligns with the global push towards sustainability and could position Exxon well for the future. Meanwhile, we heard from Ford, which is introducing a new lineup of electric vehicles, further solidifying its commitment to the EV market and potentially attracting eco-conscious consumers. These developments highlight the varying strategies companies are employing to navigate the current economic landscape and address investor concerns about growth and sustainability.
Looking at international corporate news, over in Europe, the German automotive giant Daimler is making headlines with its plans to increase electric vehicle production by 40% over the next 5 years, responding to both regulatory pressures and consumer demand for sustainable options. Meanwhile, in Asia, Samsung has felt the brunt of the tech sell-off, with shares down significantly following the massive sell-off in South Korea's markets. This is a stark reminder of how interconnected global markets are, particularly with tech sectors. In the UK, Unilever has announced a strategic review of its food brands, as the company seeks to focus more on health and wellness products, which could reshape its portfolio significantly. These international stories underscore the dynamic nature of global business and the strategies companies are adopting in response to economic pressures, regulatory changes, and shifting consumer preferences, all of which have implications for North American investors looking to diversify their portfolios internationally.
Shifting to economics and geopolitics, the Federal Reserve's latest Beige Book highlighted a mixed economic outlook, with some regions experiencing slowdowns due to economic uncertainty and others maintaining moderate growth. Inflation remains a key concern, particularly with rising oil prices adding fuel to the fire. On the geopolitical front, the ongoing conflict in the Middle East is posing fresh challenges for central banks, which now face the dual task of managing inflationary pressures without stifling economic growth. In Europe, the European Central Bank is treading carefully, balancing inflation control with economic support. Meanwhile, India's central bank is also on alert, with the rupee at risk amid fluctuating oil prices. These economic and geopolitical factors are critical for investors to watch, as they can significantly influence market stability and investment opportunities in the coming months.
So, what are the key takeaways for investors today? First, keep an eye on the oil markets. The situation in the Middle East continues to be a significant driver of volatility, impacting everything from commodity prices to inflation expectations. Second, the tech sector remains under pressure, especially in Asia, and this could have ripple effects globally. Third, with Bitcoin and other cryptos on the rise, it may be worthwhile to reassess your exposure to digital assets, considering both the risks and potential rewards. Lastly, watch for any updates from the Federal Reserve and other central banks regarding policy moves, as these will be crucial in shaping the market landscape in the weeks to come.
That's your morning briefing. Add your thoughts in the comments and let us know what you're keeping an eye on today.
And Joe, signing off. See you tomorrow.